Thank you, Mr. Chairman, and thank you for testifying today. And I want to thank PSERS for the executive summary cover letter. It was very helpful for the budget packet. I do want to highlight a couple of areas of positives that you've indicated in your cover letter, and if PSERS wants to comment on the same items, we'd appreciate that as well. Based on the 2013 survey, PSERS performance in comparison to other similar public pension funds had a 22% lower pension administration cost per member than the average cost for its peer group, while experiencing a 17% higher transactional volume per time equivalent than its peers. You want to talk a little bit more detail about what the administrative costs are per member, what drives those costs, and also then I'll get a more specific question relating to the transactional volume.
The cost per member, I believe it's around, maybe the average is 90 or so, and we're about $20 under that. I'm not sure. I'm going to have to get you those exact numbers. But we participate with CEM Benchmarking Incorporated. They're an international benchmarking company. They do provide benchmarking services for public pension funds. They have about 75 clients, and we're in a custom peer group of 13. And they try to get everything down on as much as they can to an apples-to-apples playing field. And we fill out a very detailed survey using statistics. I mean, there are probably 13 pages of very, very, very detailed questions, including cost information. And then they take out things and even it across, and those are the statistics that they come up with. I apologize that I don't have the actual dollar cost per member here, but it is certainly available. But from a percentage perspective, we were 22% lower per member. And then the 17% number was our staff productivity was greater than our peer average by 17%. And we actually have fewer staff members than we do now than we did in 2008, and we're doing more work than we did.
So it's average, it's the number of trade volume per staff member, not that you're turning over the...
Oh, I'm sorry. This is on the benefit administration part of it, not on the investment side.
All right.
So that's on this part of the house that processes retirement benefits, takes care of members' phone calls. Yes, so it's on the more the pension administration as opposed to the investment side.
Thank you.
You're welcome.
I'm not sure if that was a precursor to this question or not.
One happy customer there.
Yeah. We've heard the word index a couple times this morning. I think to follow up on what Representative Dean said earlier, let's maybe define what you're using, define what that term index means to you, because it may mean something different to individual investors that are in an index fund that has a guarantee.
Yeah, I mean, indexes are really just portfolios that replicate what you can get in the market. So think the S&P 500 index, right? It's an index of 500 companies that gives you exposure to the U.S. equity market and large cap equities, right? And there's an S&P 400 index that has 400 securities that gives you exposure to mid-cap stocks. And then there's a 600 that gives you small cap. But there's lots of different definitions of an index for a U.S. equity market. We have those across all different markets. So U.S. equity, non-U.S. equity, fixed income, commodity, real estate, so on and so forth. So there's different indexes that are available in the market. So the board, they approve various indexes that we manage the portfolio to. And they also include private market type benchmarks, which are really benchmarks of the universe of availability there.
Do we invest in index funds, for example, that will guarantee a return? Where you may be trading off some of the high side return for guaranteeing that rate?
No, we manage our indexes internally, and those indexes will give you the market return, right? Which is how they're structured. So I think the thing to remember with an equity index is you get what the market gives you. Okay, if you're in if the equity market's up 20%, you're getting 20% return. If the equity market's down 20%, you're having a 20% loss. So that's what a low-cost index does, because all the managers are asked to do is replicate what that index is. So Standard & Poor's is a company that does the S&P 500 index. They set the constituency in there, and you get essentially what those 500 companies did. So for example, last year, the S&P was up about 13.5%. What most people won't realize is 20% of the stocks in that index were down for the year, 80% were up. You've got the performance of all 500 companies that are in the index. There's like 504 or 506 stocks in the index because some companies have two different share classes. But you're going to get, it's not a guaranteed, you're guaranteed to get the market return. You're not guaranteed to get a positive return. You're just guaranteed to get what the market gives you.
Thank you. It's my understanding, at least some of the investments that I'm in, you can get a guaranteed index fund where you're not going to go below a certain rate. I may not get the full 13% return that you've indicated. There may be a haircut on that, but also on the downside, I don't have any risk of losing as well. I do want to touch base, Mr. Grossman, on the wasteful Wall Street fees that the governor mentioned in his budget. It's the same Wall Street, I think, we're hoping that returns the money that we can pay retirement systems, right?
Absolutely.
So I'm just going to read, and maybe you can get into a little bit more detail. On March 3rd, Governor Wolf presented his budget proposal. In his remarks, the governor raised the issue of eliminating wasteful expenditures on Wall Street managers and increasing the use of index funds to create savings for PSERS. Can you state for the committee what wasteful expenditures you currently have?
I'm not aware of any wasteful expenditures at this point.
Okay. To date, I would assume SERS agrees with that. PSERS has not met with the governor to talk about this proposal, so I'm assuming that's still the case as of the...
We had an introductory meeting last Thursday.
Okay. You had touched on earlier, I believe, if I understood correctly, that basically you get what you pay for in some instances, right? And you've done, in your mind, a really thorough job of interviewing managers, money managers, and you keep tabs on when managers change at firms that might put them maybe in a red zone where we get out of that management fund or whatever, right?
Yes,
is that how that process would work?
Yeah, we look at it manager by manager. We monitor those managers. If those managers don't perform, we will terminate them. And over the past 5 years, we've terminated a number of managers.
Or if managers change.
If managers, if the people process change, or there's something that changes even with market structure, where we say, you know what, it might not be as easy to beat the market anymore, we'll move into a passive alternative.
The volume that you do, does that enable you to negotiate better fees?
Yes.
Same?
I wouldn't say just the volume, it's the size of the commitments we can make. Because we are a very large institution, we're $50 billion, we make $100 to $200 million type commitments. So that gives us pricing power.
Does it give you the ability to state what fee you want to pay?
Not necessarily. It gives us the ability to negotiate a most favored nation fee, the best fee that they have. It doesn't necessarily allow us to drive the fee to whatever level we want. And so there's a supply-demand issue. A lot of the managers have capacity constraints, and they have a line out the door of people that want to get in. So you can negotiate the fee down to a most favored nation, but you're not necessarily going to be able to negotiate it down.
It's possible to pay 0.2 of a point less.
Oh, absolutely.
But receive 5 percentage points less in return as well.
That's correct.
Because of the quality of the firm and the management.
Yeah, there's certain, and especially in like private equity, you really want to avoid second and third tier firms.
Thank you.
You're welcome.